something else, given the nature of the conference, is I want to talk about how you actually put together a global forecast. We have certain specific issues at JP Morgan that make that interesting and complicated, but I think anybody who's dealing with global business cycle dynamics at some point should sit down and think about, well, if you're actually going to look at where the world is going, how would you actually do this in a practical way? In terms of doing this, I want to emphasize, again, I've already emphasized it, when we're putting together a forecast, we're trying to do it in a way that is relevant and valuable to our clients, to our firm, and generally speaking, relevant to what I think economists can actually do well. And what I actually think that tells you is you're supposed to be focusing on trying to understand where you are now is telling you where you're going to be in 6 months from now. And at best, you also can get a sense of where you think the views and the risks are going to be sitting at the end of that 6-month period. I think you have to be selective. There's a lot of things in the global economy you could be forecasting and talking about, but you have to decide what's most important. And I think you have to be global, which is something I'm going to focus on a lot in terms of what I'm talking about. In terms of the views we want to express, generally, this is the set of them. And I'm not going to go through this slide in a lot of detail here, but what I do want to emphasize is our perspective on the world is that things are lackluster right now. They're better than they were 6 months ago, but they're still, globally, we're not back to trend. There are drags that hit us. There are constraints on growth right now that make it such that performance in the world is still disappointing. But as we look at the world in an underlying sense, we see some things that get us optimistic that 6 or 9 months from now, growth is going to be a fair amount stronger. Part of that is that the drags that have been hurting us are fading. Part of it is that we see some healing from some of the damage that's been done going all the way back to the financial crisis. Part of it is policy makers doing more to support growth, and some of the bullet points there have to do with that. And perhaps the most important and interesting part of what I'm going to say, and by the way, I can't stand in one place for very long, is that what's happening now is that we've removed tail risks from the scene. A lot of what happened in the last 18 months had to do with concerns about financial stresses in Europe spilling out in the global scene, overheating in EM, China going through a hard landing, and bad things happening in Washington. And they've been removed. And I think what it's doing right now is it's opening up the door for easy money, which is increasingly important, to gain traction. And I think that's the dominant thing we're seeing right now in a world in which global growth is still constrained. And it's the dominant reason why we think if you fast forward 6 or 9 months, we're going to be in a world where growth is going to be stronger. And something else I want to talk about is it's not one which I think threatens us from an inflation point of view, at least not over the horizon that we're talking about. So the other thing I'm going to do is throw a lot of pictures at you, so get ready. And the first one just is our forecast. And I want to start with the understanding of where we've come from. Global growth effectively has been below trend since early 2011. Global growth got worse as we went through 2012. So in that context, to talk about some lifting in the first part of 2013 is not very exciting. And if you look at the numbers, just about all of the world remains below trend in our forecast through the first half of this year. But it is this process of lifting, this process that we think is going to deliver stronger growth as we go on that I want to talk about, with one other thing that you may not understand by looking at this table, but comes across strongly to me. Usually when the global economy is in a lifting phase, the lifting gets highly levered off of emerging market performance. And if you look at that table, if you can see it, and you look at these numbers, what you're seeing in emerging markets, including, I'd say, Brazil and certainly in China and other emerging markets, is particularly unimpressive. And I would emphasize that as an important point in the global outlook, is that things are starting to do better. They're not doing great. And EM is, I think, clearly a source of disappointment, or at least difference from what we've been used to for much of the last decade. Now with that, part of what I think is important in terms of putting a business cycle story together is a narrative. And I want to start with a touch of a narrative about what did we do to deserve this? What was it that hurt us over the last 12 to 24 months that delivered weak and increasingly weak global performance. And I want to argue two things. One is that credit conditions outside the U.S. tightened substantially. There's a panel here on bank lending standards from senior bank loan officer surveys across the world. And one nice thing is we have consistent surveys now to look at across a wide range of countries. And you can see something simple there that's backed up by a lot of other indicators, that in Europe, which I don't think is any surprise to anyone, credit conditions tightened a lot as we went from 2011 to 2012. And partly because of what happened in Europe, but also for independent reasons, credit conditions tightened broadly across the emerging markets. The other thing that happened, and I think is important to understand, is that a couple of times in the last year, and particularly strongly in the middle part of last year, corporates got scared. And what you see in the behavior of corporates, particularly I'd say in the middle of 2012, but also to some degree in the middle of 2011, is the fears about what was happening in Europe, the fears about some other things. China, I think, was a fear factor last year. The U.S. political scene a couple of times here actually had a material impact on behavior and near-term economic performance. So I think it's a combination of these drags and fear that really have contributed to what we've been seeing. What's the outcome of that? Well, one thing that's interesting and important is the outcome has been a fairly significant shift in relative performance that we've seen. I've scaled the EM here, which is on the right scale on these GDP, relative to its average differential to the developed world over the last 10, 12 years, which is about 5 percentage points. And you see on that basis meaningful underperformance, and you also see meaningful outperformance of the U.S. relative to EM as well as to the other developed world. There's another rotation going on here which is a little more subtle but no less important, which is that corporate performance has weakened relative to consumer performance. That's been significant in emerging markets, but it's been present in the U.S. and it's been present in other parts of the world. So those rotations, I think, are worth noting and have, I think, had an impact in the way markets have been pricing different assets. The other thing that's going on, and to me it's been the one that I've probably spent more time debating with people in the last 6 months than anything else, is that inflation's getting very low in the world. The weakness in growth matters. The weakness in EM growth relative to DM growth matters. And we've had a lucky run here that agricultural prices, after surging in 2010, 2011, have actually fallen in our broad commodity price index 20% over the last 12 months. I don't think that has to do with macro conditions, but it matters for inflation performance. I don't think I have to tell anybody in this room that. But looking at core inflation numbers, and here's the US and Euro area numbers, it has moved down. They're both sitting close to 1%. And a lot of this, both the up and the down you see there, is the fact that we live in a world today where a good portion of inflation performance, at least in the short term, is driven by global developments. EM pricing power, the strength in global commodity prices, this had a big effect on inflation dynamics. And the backdrop we've lived through for the last 18, 24 months has taken a lot of steam out of this. Something I'm going to get into a little more later in terms of how we talk about process is we have a top-down model on inflation. It's been running well below what our individual economists' forecasts have been. This has been not only a conversation I've been having with clients in the last 6 months, but I've been banging on the heads of my individual country economists as well to try to get them to see what we're seeing from the top-down point of view. We talked about credit conditions tightening. We talked about fear. I want to talk for a second about central banks. And I want to say something which will be a little different than what Professor Perscott said, which is I think the Fed matters. I think the Fed matters a lot in a lot of different ways. The U.S., as has been noted, and I think everybody can see, has not done that well over the last couple of years. But as I noted a minute ago, relative performance has been good. And then look at U.S. performance from the composition of growth. The U.S. has been suffering a significant deterioration in external performance. The U.S. has been suffering a significant tightening in fiscal policy. And the U.S. has been held up and supported in a very big way by interest-sensitive demand, consumer durables, housing, and business investment. And I don't think you want to put entire weight of that on the Federal Reserve, but I think you got to give a lot of weight to a Fed that in an environment where they've been constrained by a zero interest rate bound, they've used creative tools. And I think I'm not going to have time to get into this. It's not about the balance sheet. It's about Operation Shout. It's about communication tools that's been driving the way the Fed has been providing additional stimulus to the market. And through the Fed's actions, they've been able to push real interest rates down. They've been able to anchor inflation expectations. They've been able to change market expectations in a way that has allowed the economy to do a fair amount better than it would have otherwise, and that other countries have done. And sometimes I get exhausted from doing this, but I want to put in my 2 cents about giving the ECB a hard time, which is to say that there are a lot of problems in Europe that have nothing to do with monetary policy, but the ECB does have a responsibility to manage demand conditions in the region as a whole. And when you look at the region as a whole here, it's amazing that we have seen unemployment rates rise almost 2 percentage points over the last 18 months. We've seen inflation go down to something close to a percentage point below the central bank's target. And we're seeing fiscal policy on an underlying basis tighten by more than a percentage point over the last 12 months. And the ECB, up until last week, did nothing. And I'll give them credit for the OMT. I think it's been a hugely important event, but effectively it fixed something that they broke by not providing the sovereign backstop that every country who's issuing debt in local currency should be able to have. Certainly any country that's supposed to be able to run debt to GDP at 60% should have a sovereign backstop in the form of their central bank. Okay, that's a story for another time, though. Let's go to the forecast now. Why are things getting better? Well, they're getting better, I think, partly because these drags are fading. I think the OMT program did some good in Europe. It's gradual. It's not happening in terms of the way we might like, in terms of thinking about how financial conditions have improved since the OMT program has come in place. They've actually been more important improvements in the core than in the periphery. But things are happening there. Credit conditions are starting to ease in emerging markets. I think you can see the give and take of that in a country like Brazil. And we are starting, looking at sentiment indicators of corporates. We did see, coming out of the summer and through the end of last year, businesses begin to reduce their level of fear. Again, we removed a lot of those tail risks, certainly didn't go over the US fiscal cliff, and I think businesses responded, and we've been seeing some improvements based on that. But I want to talk about the constraints for a second, and I think 2 constraints that I want to highlight are, 1, fiscal drags that continue to be significant, and in fact the US fiscal drag intensifies and is probably at its most intense right now for the cycle. But 2011, 12, and into 13 in the developed world, fiscal policy becomes an increasing constraint on growth. The good news, and something worth considering, is that that drag is going to moderate quite a bit as we look towards next year. The other story here, and I think there's a secular as well as a cyclical component to it, is EM corporates are in lousy shape. The excesses of a decade of strong growth, of easy access to credit, of tightening labor markets, put in the context of 2 years of weak growth, diminishing pricing power that you've seen, sticky labor costs, and policymakers everywhere outside of Brazil not really wanting to aggressively offset that, has delivered very poor corporate performance in EM, has delivered weak corporate spending, deteriorating credit quality, and I think it's a major part of the reason why the global economy's lift here is being constrained. And that's not going to go away quickly. I think the hope is it does get better, but I think to talk about it going back to where we were two years ago, let alone where we were in the middle part of the last decade, I think would be way too optimistic. So now I'm going to get into what I'm not sure how many of you are actually involved in this debate, but is actually the central debate going on in markets right now. We started the year strong. We had this lift, and I think some of it was the idea that that sentiment shift had some impact, particularly had impact in the manufacturing sector. And things are cooling off right now into the spring, particularly in the manufacturing sector, where our survey data have begun to turn softer. This is a purchasing managers index that we track on a global basis. You look at the internals of it, you're seeing inventory positions move higher, you're seeing orders move lower. We have a nowcaster on the global economy, which I'm going to talk about in a little bit, which has started to move down. And we have the backdrop of last year in people's minds, the growth scare that happened, the shift in corporate behavior last year. Are we going to follow that same path now? And our simple answer is no. Not that things are going to get all that good on growth right away, and in fact, this slowing is not by any means over, but we think the environment here is much more solid in terms of holding the line, in terms of the forward arrow on growth, and as I said up front, to provide us with an opportunity to lift into year end. A couple of things here globally. We're getting the benefits of what's been happening in commodity prices. In sharp contrast to the last 2 years, where in the first half of the year, at some point we went through a significant spiking up in energy prices that had an impact on global consumer spending. In fact, now we haven't had that real slow phase, and we're actually in the process of getting a significant benefit. In the US, March CPI was down on a headline basis. April CPI is going to be down on a headline basis. And unless something happens very quickly in energy space, May could also be down on a headline basis. We're getting a purchasing power lift here, which I think is positive. I think the US is, in my mind, also central in terms of thinking about where corporate behavior goes. And if we process information in the labor market in the US in sharp contrast to what happened last year at this time, we're not seeing the breadth of pullback taking place in the labor market. In fact, I don't know how many people saw, but today we hit the lowest level on initial jobless claims for the cycle at 323,000. This is the monthly average for April. We're into early May, and we're running even lower than that. I don't feel like that business sector story of pulling back is what's happening now. And I want to come back to the basic point I started with, is that there's a shift taking place in monetary policy, and the traction of monetary policy combined with the lack of tail risks in the picture is a hugely powerful story in, I think, the global markets right now, and looking forward in terms of how you would want to project it onto the scene in terms of global growth. And I want to emphasize not only that what the Fed has done has been important for the US, but it has been an important export of the United States. I don't think there's any doubt that what's taking place in Japan now reflects a shift taking hold in society after having had 15 years of deflation, which has cushioned the household sector, has delivered those per capita GDP numbers that Professor Prescott was talking about before, but has delivered high real interest rates, high real exchange rates, high real wage rates, and has killed corporate behavior, has killed Japanese competitiveness. And you combine that with the 40% nominal rise in the yen that the Bank of Japan let happen in the period after the financial crisis. And now you have a Fed that's writing a narrative which is very different and is seriously at odds with the Bank of Japan narrative. You have the recipe for what has been a regime shift, which I think is really important and is fundamental in terms of thinking about the Japanese economy. The ECB, slow, I think is significantly hampered by a lack of tools to use, but is fundamentally, I think, still not in the mode of telling us it cares about macro performance enough to deliver the kind of stimulus and shift we need in financial and monetary conditions in the euro area. But the pressure is building, and one of my first bullet points, and I think it's true, is that the ECB is the most interesting policy agent right now in terms of thinking about what's happened. It has an incoherent policy framework. It's under an enormous amount of pressure. It's the place where things can surprise us in most interesting way. Not that I'm all that excited about what actually will happen, but I think those are the kinds of situations when looking at the macroeconomy, you should be open-minded to things happening in a different way than you expect. I want to shift gears here for 1 second before I talk about process, and just as you can see in what I've talked about up till now, I'm not sitting here trying to talk about the next 10 years in terms of what's happening in the US, what's happening elsewhere in the world. But I do feel like we need to think about those things, and we need to actually integrate it into any kind of short-term thinking. And I just wanted to highlight 2 points here. One which is about China, but I think has resonance through other EM countries, and that is the efficiency of the use of capital. We've had a very good run here for 10 years in emerging market growth. Credit has been easy. I think things are getting a little tougher here. And I think what we're watching in China, and by the way, I think the first quarter GDP disappointment was temporary. I think we're going to bounce off of that. But what worries me is how little growth you're getting for such strong credit gains as you're seeing now. And by the way, I'm sure if I say this, that's a story that resonates when you think about Brazil as well. I think the ability to create distribution systems in the financial sector, broader systems overall that efficiently allocate capital, is the need and the hope that can keep EM growth going. And right now, we're not all that optimistic about the way things sit at the present. And certainly what you see in China right now, in some respects, is worrisome. Finally, on this front, we could get into a long conversation about NAIRU in the U.S., where the participation rate is going to go, trends in productivity, as Professor Prescott mentioned. There's one other thing which I'm mentioning here just because I don't think people think about it enough, and that is what's happening to U.S. population growth. It's collapsing. In the 20 years through 2000, our population was growing a little over 1%. The latest estimates by the census, which were updated for the 2010 census about 2 months ago, has the next 10 years growing 0.25% per year. That's a huge drop. I think people have not really brought that into their estimates of potential growth sufficiently. I think most people still use a number of 6 to 8 tenths on population growth in the U.S., and that may be reasonable for the next few years. We do believe the cyclicality of the economy will allow participation rates to pick up. There is a capacity here with a lot of slack, but we are in an environment of very weak underlying demographic change, and I think one thing that's underappreciated is the role of immigration has played in that. More than a third of that decline has been through changes in the immigration profile, both what we've seen since 2000 and also what we are now projecting as we go forward 5 or 10 years. Better growth cyclically will get you better immigration, but there's a lot of policy stuff. And I would just say as a last point here, what happens on immigration policy this year, where it's up for legislative change, is a pretty important point on U.S. performance if you think forward 5, 10, 20 years down the road. Okay, so now I'm going to change gears entirely. I'm going to talk about how we put together a forecast, having now given you a forecast. And I want to start by saying it's not an easy thing. I've been doing this for a long time. I'm almost embarrassed to say I've been doing this for about 20 years now. But, okay. We have a blessing at J.P. Morgan that we're a global institution that has a footprint in a large number of places in the world. And because of that, I have a team that is basically sitting in all of the places where we take risk in markets. I don't even know what the number that's on that map is, but I think it's somewhere between 35 and 40 people. And what I have here is only the professionals that are client-facing, that do analysis and actually speak to clients of the firm. Out of that group, I think about 25 of them have PhDs, and probably 15 to 20 at least have worked at central banks or international institutions. So we've got a nice group here of people who are following the world on a high frequency and in-depth basis. The U.S. group has some Latin economists. Our Argentine economist, our Andean economist is sitting in New York, and in the London office, you're basically covering the entire continent of Europe here. So these are not, we're not doing that much work on the UK or even the US. We have a team of only 3 doing the United States. So what's the way you put together a global effort with all these people? And I can promise you that anybody who's worked with economists knows that herding cats may be even easier. It's not so easy to get 35 economists to be working in the same way. So I want to emphasize 2 points here about doing the global economy in a consistent and a coherent way. One is about creating processes through products. I think it's your product mix of what you present to the world that drives your process. And if you care about your process, you better care about your products in that way. And then the second thing, which I hope you get a sense of from what we've talked about thus far, is we're a big believer in top-down and bottom-up interacting. We have a top-down effort that works together, but somewhat distinctly from our bottom-up effort, and that interaction is a very key part of what we do. So let me talk a little bit about the products and process. So what do I want from my economists? I want them to do some things in a way that they are all doing the same thing. I want them all to be focused on being grounded in the data I want everybody to be looking at their data, whether you're looking at CPI in China or CPI in the US. I want everybody to be forecasting and reviewing their numbers as they come out, as they're going to come out, and as they do come out. I want everybody to doing that in a consistent framework. So I'm forcing everybody, whether CPI is seasonally adjusted or not, we're going to seasonally adjust it. So we're going to have people forecast the same thing in the same way in every major place in the world. I'm going to do the same thing with the macro variables. China doesn't deliver good quarterly, seasonally adjusted GDP numbers. In fact, when we started doing this thing 25 years ago, very few countries did. But we were seasonally adjusting and doing it, because to talk about Mexican GDP on a year-ago basis alongside U.S. GDP quarterly annualized, you don't get a consistent conversation. The other thing we do is we limit the number of data points that we ask people to look at. If I was going to have my economists have to forecast 50 or 60 variables and give me a GDP forecast that had 300 subcomponents to it, it would be a mess. You got to focus on what you're asking people to do. And we combine that with an idea that once a week, everybody should take stock. Everybody should write a few paragraphs at the end of each week where they take stock of their own country. And that taking stock process is not only healthy on an individual basis, but by doing it together, it actually creates a lot of commonality. And then the last thing we do is we ask people to do research, although what we ask people to do there is research, and we let them generally define what they think is the most important and relevant thing for their local market. And that's where our products come in. We created a product. This product, by the way, is going to hit 25 years old in January. We're thinking about having a party, and you're all invited. I hope, I'm not sure about that. And it does this. It has a place where everybody's forecasts are seen, everybody's forecasts are reviewed. And I think an important part of this is that by putting your forecast together and by making it clear what you've been successful at, how far you've been off on your forecast, having people show their forecast alongside each other, having people show their research alongside each other, you develop a process in which there's more consistency and more commitment to doing things in the way you would like. I mean, the other thing that happens as a result of this, which I think is really important, is it generates a global effort, which I've kind of put at the back of this, but in some ways that's the most important thing. One side point here, but it's an important point for me, is 25 years ago when we were doing this, this was basically a physical paper document that was distributed. Over the last 5 years, it's increasingly been a document that is distributed electronically or looked at on our website. Right now, we get about 16,000, 17,000 people opening this document each week, and these are just clients of JP Morgan. And what's interesting is that I think in 2 years' time, we're in a transition now, this document is not going to exist. What we're going to have is effectively the same process, the same type of product, but it's going to be purely a web-based electronic product. And we're already in the process of creating that website, which allows us to do all the stuff we're doing, plus other things, including mass multimedia type stuff. Is a cool thing we've got in the new part of the website where when you open a document and you see a chart, you can click on that chart, get the data, download the spreadsheet, things like that. There's a whole set of things, obviously the hyperlinking stuff. And you got kind of cool things you can do with calendars where you can have people create, I just used the UK one here because if I did the global one it wouldn't fit on the page. But you can create situations where people can click on the calendar points and you can see the previews and then see the reviews when they come out. There's a lot of cool stuff you can do, and also with the forecast you can scroll back and forth and see what you want with the forecast. So there's a lot of stuff going on. It's a kind of an aside. The technology is not changing what we're doing, but it's allowing us to do things in, I think, a way that opens up the process much more to the people who are using it, and also allows it to be much more of a real-time process of doing the work rather than a once-a-week publication we send out. Okay, so the last thing I want to talk about here is the top-down, bottom-up side, and this is, to me, crucial. You cannot put together a global forecast by taking your Chinese, your Japanese, your Brazilian, your US, and your Euro area forecast and you're just pasting it together. And we found it increasingly important to also have, rather than just getting those people together and talk, but to have some kind of guidelines for showing them what the world looks like if you took the world as an entirety. And we've been increasingly generating tools. We've been increasingly generating a process. One thing we've been doing for a little over a year now is we have this Nowcaster tool, basically a common factor model that looks at the global economy from the point of view of just including the global indicators that we create. I mean, you could do this through everybody individual country indicator and have U.S. claims and U.S. durables in it, but we're using the 7 or 8 variables, and I'll show you in a second, that we aggregate on a global basis that's monthly, that we think and statistically shows interaction with global GDP. Just to show you what's been the reliability of the series, you can see the quarterly tracking of this relative to GDP. You can see an interesting error that has played out in the first quarter of this year, and it's been a pretty important dialogue point. This is the weekly tracking of our Nowcaster. This is the weekly tracking of our bottom-up forecast. From a standard error point of view, this gap is not that large. The standard error of our Nowcaster by the end of a quarter is still close to 1% on GDP. But this is large from the point of view of the story we're telling, whether global GDP is 2% or 3%. And we've been having a lot of dialogue, and you can sort of see, I don't think it comes across as clearly, that the bottom-up was starting to come towards the Nowcaster. The Nowcaster has been flat as a pancake as the weekly data have come in. And then as we've begun to get GDP reports in, we've actually seen that the actual numbers are not tracking where the Nowcaster is. One other thing, here are the indicators we use. One interesting observation about it is once we estimate this model and we ask the question, which of the variables we use has the most bang for the buck in terms of influencing the common factor on global output, what you get, perhaps not surprisingly, is the hard activity variables. You know, a 1% change in retail sales globally has a pretty strong effect on our common factor, as does manufacturing output, and you can see the other variables here. But something you got to understand when you do global tracking in real time is what comes first matters a lot. So when we look at within the quarterly data release cycle, what actually reduces the standard error the most, it's actually the PMI surveys. And the reason is that they're not more important, but it's because they're timely. They come out first, and they incorporate some of the information that's in the activity variables. And for that, you can understand why these survey data have become so important, have become so actively used and traded on in the marketplace. Okay, so I'm going to end on one last note, is we have a global conference call every Thursday morning at 7 a.m. Used to be done at 9 a.m. until my Asian economist beat me into doing it earlier. What would we have talked about today? Well, a couple of things, some of which we've already mentioned. But here's our Nowcaster exercise. It was running 3.2 in the first quarter, running 2.4% so far for the second quarter. But what we actually have for the second quarter really is only 2 hard data points, which are the PMI surveys. Everything else that's coming out of this is being effectively forecasted by the Nowcaster. The Nowcaster at the first month of a quarter is not a Nowcaster, it's really more of a forecaster. But it's interesting because the Nowcaster, taking a disappointment in the surveys in April, is projecting weak industrial activity. We also cross-reference that against what we've been seeing in terms of the details of the survey with the orders and inventories, which are not independent measures in the Nowcaster. And we get a message that, yeah, there's a real story here that we have to pay attention to. How much of that is going to project itself in the retail sales space, how much of it's going to project itself in the capital goods order space is interesting. But we both recognize the relative limited nature of the Nowcaster as a forecaster in the first month of a quarter, but the importance in terms of trying to process that information systematically when we talk to our economists. And by the way, the Nowcaster is sitting at 2.4 for second quarter. It's sitting at 2.2 in April. Our GDP forecast for the second quarter is at 2.7. Again, not a big statistical miss, but a different story in terms of where we stand now. So I'm bringing that up, and we already talked about the CPI stuff, so I'll kind of leave that conversation. We don't do nowcasting for the CPI because we don't have inputs that really lead you to your monthly forecast. We just have models that try to be on top of what the momentum swings, what the implications of future prices and commodities are, and basically project that out and see how it lines up. One other quick thing, because I think Vale may be interested in this. You have daily commodity price indices, and in principle, if you estimate common factors out of that, there should be a demand indicator that comes out of that. And we do run a nowcaster of global commodity prices to try to line it up with global IP. And so far we haven't been really that happy with its results, but we have that tool as well. It's an interesting tool to talk about, and if anybody's more interested about it, I'd be happy to get into that conversation. So hopefully this was at least mildly of interest to you, but I'll leave it there. Thank you.
Thank you very much, Dr. Bruce. Now we're going to have 15 minutes for questions from the floor. As formally, each person that's make a person, I would like to make himself say where he's from, his affiliation, and then Dr. Bruce is going to be glad to answer the question.
Hi, my name is Fernanda Guardado. I'm an economist at Brasil Banco Plural. Congratulations on your presentation. It was very good. But you did raise a question I was not aware of, that the population in the US is growing much slower than it used to. We see the same thing happening here in Brazil, but we are on the other side of the labor market. We have very tight labor markets. Yep. So do you think that, if I understand correctly, the belief that many have that once the labor market in the US picks up pace, you will not see, you might actually see a decrease, the unemployment rate decrease a lot faster than we imagine. Is that it?
No. I think there are two separate issues here. One issue is how much slack is there in the economy, and how fast will the labor force grow in an environment in which the participation rate is depressed. And then there's the other issue of what is happening to underlying trends in productivity and what's happening to underlying trends in population. And it's, I think, a subtle story. Well, it's not subtle at all. It's an important story that has big things happening in different directions. Our view, and I'm not going to get into a long conversation on this right now, is we think the participation rate has a heavy component of cyclical weakness associated with it. There are a lot of people in school. There are a lot of parents taking care of kids who would want and eventually will want a job, and we think will come back into the workforce. So our estimates are that the output gap in the U.S. right now is somewhere between 4 and 5%. So that means the U.S. can grow 1% or further above its trend pace for quite a number of years. However, if you take the population estimates at face value and you take the capital deepening story at face value, which has been weak, and I haven't talked about that, it's not hard to get a message that potential growth in the U.S. is somewhere between 1.5% and 2%. So I think we have a lot of slack and a low potential growth rate right now. And I think, you know, that creates sort of somewhat ambiguous message in terms of what's going to happen in the inflation performance in the Fed. I think for the near term, and I mean the near term being the next year or two, I think the slack story is going to be the more dominant one. But if we care about the U.S. economy over a longer horizon, I think we have to think about that slow supply side story as well. And policymakers can do stuff about it. If you want to, if we can change immigration policy and you're interested in a job, you should come talk to me. We can help out each other.
Hi, I'm João Whistler from FGV. So I have a question. Your models, do you have them in mixed frequencies, coupling quarterly data for GDP and monthly also, or do you have them separately? How does it work?
Well, the Nowcaster model is estimated on a quarterly frequency, but it can generate monthly GDP estimates, and that's the parameters come from the quarterly estimation, but the data is monthly, and we use it on a monthly basis. So we're using it both to track where the quarterly numbers line with our bottom-up estimates on GDP, and also looking at the momentum on a monthly basis. And we have other models, the CPI model, which, again, globally, there are relatively few countries that look at CPI on a month-to-month basis, seasonally adjusted, but we are trying to do that and talk through the analysis of that. And we're also trying to connect the other monthly data flow that we have, both through the lens of quarterly GDP and also just momentum. You can obviously, I think, get somewhat thrown off course by some of the monthly volatility that you get that gets generated in our monthly GDP estimate on the Nowcaster side sometimes. And you have to be careful in terms of looking at it. But we are trying to do that, and as well as I talked about this commodity price thing, we are kind of working on some tools that are even higher frequency, although I don't feel right now they're ready for prime time in terms of presenting to you and using actively in our analysis.
Actually, in our presentation, we're going to have commodity price variation and global industrial production showing some synchronicity in cycles. So that's
I'm not sure I'm going to, unfortunately, be here for that presentation, but let's talk. I'm certainly interested in that stuff. There's one over there.
Hi, Bruce. I'm Adama Nozildirim from the conference board in New York. You didn't speak very much about the fiscal drag and the impact of austerity for the U.S. economy in 2013 and maybe even beyond. So that's one question, but a follow-up is whether or how much impact do you see of that spilling over to the global economy?
Okay, well, yeah, there's a lot of things we didn't speak about. I at least hope I made some reference to it, which is the idea that the fiscal drag is large this year. It's front-loaded in the first half of the year. And I think it's going to fade pretty quickly as the year goes on. So right now where we are in the U.S. is we've absorbed some of the increase in taxes early in the year. We've partly absorbed it because we had a temporary and large boost to income at the end of last year, front-loading income before the tax changes came. But the big part of it is we had the saving rate go down about a percentage point relative to its previous trend. One issue, and I think it's actually a more important issue than the debate about sequestration in its impact, which I think we can see and understand it matters, but it's not huge, is what's going to happen to consumer behavior where savings rates today, as measured, are low, where wealth effects are building in a positive way, and where consumers are going to get some purchasing power lift here from lower energy prices. And that's a big wild card in our near-term forecast, our 3-4 month out ahead forecast about the economy. But we would estimate the fiscal drag in the first half of this year probably somewhere a little over 2% of GDP. We'd estimate it in the second half, building in some rebuild of savings rate and the sequestered, at probably somewhere about a 1 or 1.25% of GDP. And we would estimate the fiscal drag for 2014 at about 0.5% of GDP. So that gives you a sense of the profile of that fading. I don't have a view on that on the global basis beyond what it generates in U.S. output. There's nothing special about the fiscal impulse relative to the other things going on in the U.S. economy, which many of them matter as much as your fiscal side of the equation. And by the way, just if you put that number in context, if we're right that the U.S. is generating roughly 2% growth in the first half of the year with a fiscal drag that's accounting for something close to 2%, it's telling you the private sector is actually doing pretty darn well underneath the surface. And I think that is an important issue, is does the private sector hold up as well in the aftermath of that drag? Part of that underlying growth in the first half, though, is the fall in the savings rate, which I think is temporary. So, I don't think you want to just extrapolate that mechanically. Anything else? Okay.
There is no more question. I'm going to make one myself.
Okay.
In your talk, you made very clear that oil price is very important in terms of the impact on your forecast. What is going to, in your opinion, in your model, what's going to be the impact of shale gas, of this new technology that was made available in the United States?
Okay, is it possible to bring the presentation up again? Because I want to show a picture. I think there's three dimensions to it as I see it. One is, let me see if I can get to this page. There's a lot of stuff back here that I didn't show you. You should be thankful of that. So here's production and investment in the energy sector in the U.S. Boy, that doesn't impress me very much. Both of them are sitting around 1% of GDP. Both of them are sitting today lower than their levels before the financial crisis. I think from the production side of this, its impact on the U.S. is somewhat hyped, and unless you give me numbers that are a lot larger than what I believe, I don't think it's going to add very much to U.S. output over the coming years. That's not to complete the story, though. I think the big part of the story is what you think that the change in the U.S. energy sector does to global pricing. You know, if you think that it can materially lower the relative price of energy consumption in the United States, and you're talking about numbers which I think you have to believe it's going to do it by 20–30% or so on a sustained basis, then I think you could start to talk about a real macro impact. We could talk about a reversal of some of the dynamics we've seen in the 70s and 80s. And then I think the third point, which is not one easy to put in a macro forecast, is we are becoming energy independent on a regional basis. And sometimes I think people talk about the U.S., and I think we should talk about NAFTA. The U.S., Canada, and Mexico are a unit which is energy independent, and it's a unit which is politically stable, and it's a unit which is changing the dynamics of our volatilities and vulnerabilities in global markets, but it's also changing the political landscape. Is it better that the U.S. disengages in the Middle East because we don't have a strong interest in that? And what role does that play in pricing? And what role does that play more broadly? I think those are a lot of questions I don't have easy time making strong statements about, but I think those are huge parts of how you want to think about this over a horizon of 5 or 10 years. But I emphasize the production side of this, I think, is overblown. The other stuff here is interesting, but I still think it's more hope than any kind of promise.
Thank you very much, Dr. Bruce. If there is no more questions, then I'm going to proceed to another presentation.